This is one of these reports that you really want to look through. From our perspective, this is really more of a technical factor that's playing out here today. It's just a high seasonal hurdle. Without getting into too much detail and boring everyone to tears, I think the reality is last month there was a really favorable seasonal hurdle. That's why we actually saw an increase. This month, we're going to see a much higher seasonal hurdle. It means we're going to see a decline. I think all that aside, I think the reality is once we turn the light switch back on from an economic perspective, we'll get back to the business of gaining jobs. But we're going to have to get through this tough one first.
All right, back to the 10-year. Goldman Sachs and TD Securities out with a new 2021 year-end forecast, calling for yields to hit between 1.9 and 2% by December. Now, in its note, Goldman says, while we think there will be some near-term consolidation, we believe strong economic data will lead yields to resume their upward trajectory in the coming quarters, and we therefore revise up our projections. Tom, a lot to digest there. What's your take on this?
Look, I think it's interesting. When we were putting out, probably like everyone else, when we were putting out our year-ahead forecast, we envisioned yields would rise really across the curve. We thought that the process would be much slower. And I think in fairness to us, we have a pretty constructive view on the backdrop. I mean, I think anyone who knows our research well knows that, we've been probably a lot more constructive than most other folks out there. But I think for us, when we built in sort of more of a gradual increase in tens, the rationale behind that was, look, the economic backdrop would allow for yields to rise fairly significantly. We just didn't think everyone would embrace the idea that you're going to get strong growth and strong inflation this early in the year. Despite the fact that we had been thinking that for quite some time, we just thought that the market would embrace it much more slowly. So, we're sympathetic to the rise in yields. Again, we've also had to adjust our forecast for the end of the year. And so while I think that there's obviously some, well, maybe it's not obvious, but while I think there's some additional lift in 10-year yields, I would actually say that I think the real heavy lifting at this point is probably in the front end of the curve. Because I think you have to keep in mind, while it's true that, if the market's building in more inflation, more growth, yes, that should obviously allow, 10-year yields should rise in sympathy with that view. But the natural next extension of that idea is, oh, well, the Fed is going to respond sooner. And so when that idea starts to really sort of gather a bit of momentum, which seemingly it's starting to gain a little bit of momentum, that means that you're going to allow the front end of the curve to really release. So you could see 2-year yields 50 basis points or higher by the end of the year. Particularly, and sorry, let me just make this last point, particularly if it is true that this will then mean that the Fed actually has to start the process of tapering before the end of the year, and that, 22, the real conversation there is, hey, is the Fed actually going to wind up hiking next year?
So, Tom, let's get back to your estimate. As you just corrected me, and I appreciate that, 100,000 jobs lost, actually, in February.
Yeah.
What data or trends are you seeing that's leading you to that estimate? And is this the floor of the job market in 2021?
Yeah, it's a great question. So, as the right way of thinking about the payroll report today, or today meaning like sort of this period, is really you want to look at initial jobless claims or continuing claims, really, survey week to survey week. And when you do that from sort of the January survey week to the February survey week, because of course this is a February report, what you see is that there was they were actually fairly flat. And so in that context, once you apply the seasonal adjustment factor, it winds up giving you this modest decline. In terms of, do we think that this is the last of it? It probably is. I mean, look, it's not like I think, job growth is going to start roaring back next month. I think, we're going to have to wait for things to really start to gather a bit more momentum. But I would say it this way. Whenever it happens, whether it's in the next month or in the next couple of months, I would say by the end of the year, you're probably looking at a dynamic where you're pretty darn close to full employment in the United States.
So are you saying that you actually see unemployment going back to that February 2020 level of 3.5%? And if so, what sectors do you see coming back first?
Yeah, that's a great follow-up question. So no, that we were wildly below full employment when back before the pandemic. So full employment is probably somewhere between 5 and 5.5%. So we see the U.S. economy getting back to, again, what we would define as full employment by the end of the year.
Shepard Smith here. Thanks for watching CNBC on YouTube.